Good evening and welcome to the January 28th edition of Bond Squad After Hours. As always, this broadcast is brought to you by Wealth Strategies and Management, LLC, located 907 Main Street in Stroudsburg, Pennsylvania. We offer complete wealth management and investment strategy services. Investment management is offered through Private Advisor Group. Private Advisor Group is a separate entity from WSM LLC. We come to you this evening after the Fed released a dovish, hawkish, was it dovish? Maybe it was hawkish statement following the two-day FOMC meeting. It probably depends on which side of the market you're on. The equity market seemed to focus on the fact that the Fed did not rule out raising interest rates this year, so it took it as a negative. The bond market and Bond Squad, I think, more correctly so, read the statement and say, look, they're going to be conscious. They, meaning the Fed Open Market Committee, will be more conscious of what's going on in Europe, and they won't be so hasty to raise the Fed funds rate. 6 and 1/2 dozen the other. Look at inflation around the globe. Do you really think that rates need to be raised at this point? Actually, Bond Squad does, but not for inflation purposes. Just to rein in some of the risk-taking that's out there. But that's for another time. Let's go over the Fed statement. The Fed stated that the labor market conditions have improved further with strong job gains and a lower unemployment rate. On balance, the underutilization of labor resources continues to diminish. The market-based measures of inflation compensation declined substantially in recent months. Survey-based measures of long-term inflation expectations have remained stable. The Fed also called recent inflation downtrends as transitory, meaning temporary, and believes that inflation will slowly march towards its 2% preferred rate over time. However, the Fed did acknowledge that inflation could trend lower in the near term. The Fed said in determining how long to maintain this target range of 0 to 1/4 on the Fed funds rate, the committee will assess progress, both realized and expected, towards its objectives of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures, and inflation expectations. It also said that it would include readings on financial and international developments. All right, this is the first time that we really heard the Fed, in a statement, acknowledge that international conditions could affect the Fed's decision. Now, this begs the question. What does that really mean? Well, it can work one of two ways. If the dollar keeps strengthening and the Fed raising rates would tend to strengthen the dollar, that would make U.S. exports competitive. And we've seen that. We've seen some of the S&P 500 companies, the multinationals, really take it on the chin because of the strong dollar. And that also hurts onshoring because it makes foreign labor cheaper. Puts downward pressure on fuel, which is great if you want to go drive to the mall, but it also makes shipping goods from overseas and foreign manufactured goods overseas cheaper. And ships are fired by oil. So one could take that statement that the Fed is watching overseas difference. One of two ways. The bond market took that to mean that the Fed would remain accommodative, and that's Bond Squad stance. We don't think the Fed is going to be in any real hurry to raise rates. We believe the Fed should, at least a token quarter point raise at least once this year. Our base case is still September, if only to replenish the ammo and show the world that, hey, the Fed is serious, and it's not going to be cornered into a position where the markets or foreign economies force it, to do something it really doesn't want to do. We don't think the Fed does anything this year for the most part. Yeah, our base case is September. We hope, we think. But Ellen Zentner from Morgan Stanley put out a report yesterday saying that Morgan Stanley's forecast is for no Fed funds rate hike until March of 16. She very well could be correct. If we believe that if we're wrong, It's either going to be because they go in March of 16 or in June of this year if they move it up early. Bill Gross, now of Janus, believes that the Fed goes in June, but he thinks it's one and done. We also believe if they go this year, it's one and done, except we think September. Fed's not going to move rates very high. The new normal neutral rate is probably somewhere around 2% this time. So it could take a couple of years to get to 1. The Fed's going to be in no hurry to do it. There are, as we said many, many times, there are structural problems holding down inflation. It is not temporary. It's not cyclical. It's not because rates are too expensive and leverage is too expensive. We have declining population growth in most developed countries. In some countries like Japan and even China, we have population contraction. We have technology. Technology is a huge, huge driver of efficiencies, and it's rendered many jobs obsolete. You don't need as many people to do these jobs. So, like I said before, U.S. labor competes with global labor and technology, and that's just the way it is. It's becoming more and more efficient. And here's an interesting stat we wanted to share where technology might be playing a part, and it's in the oil in the patch. Last week alone, from last week to this week, U.S. domestic oil production increased by 8.9 million barrels. This is with oil now at $44 a barrel and averaging 45 for the past week. Production increased by 8.9 million barrels. All right, that was about double what street experts were forecasting. These companies have sunk costs. All right, they bought land or leased land, they bought the equipment, they're ready to go, and they owe money on it. They need to generate some revenue to pay the debts on these operations, to pay the bills. If they generate half of that, it would be better than generating none of it. These are fixed sunk costs. They can't help but pay them. Unless they default, and that's another story. What's happening here is that these companies are becoming more efficient, and they're going to be able to get this oil out of the ground and be profitable at lower and lower prices. And this is not unique to the oil patch, right? This is something that happens in every single business. Apple had great earnings, right? Back in the 1980s, you could buy an Apple computer for $1,500. Today, for the same $1,500, you could buy an Apple computer, an iPad, and an iPhone, and probably a year's worth of cell service. All right, that's for $1,500. That's not adjusted for inflation. That's $1,500 raw dollars. All right, their efficiencies breed either price disinflation and or increased service or better features for a given price. That's the reason we don't like monopoly. We want to we don't want one company or a few companies calling the shots, controlling prices, and pretty much giving consumers what they feel like giving them. We want competition. Well, competition is going to lead to what? Lower prices or better goods and services for that price. Why should it be any different in oil? Why should it be any different in electronics? Why should it be any different in any industry? And we're here fretting, wow, inflation's low. Well, unless you get demand that's far outstripping supply, you're not going to see inflation, right? You're not going to see inflation coming from Europe. You're not going to see it coming from Japan. I don't care if they fly over the cities and drop currency. You're not going to see inflation. They'll just go and buy treasuries, put it in the bank. That's what they do. All right, they're not going to do it. It's not going to happen. All right, so we're going to have low inflation for a long time. We could be in a new normal situation. Mohamed Al-Ariana said it. Bill Gross said it again today. We've been saying it. Gumlock's been saying it. It seems the bond guys really get this. And the equity guys keep saying, no, the bond market's going. We got to have inflation. Look at the growth we have. Rates have to be higher. Again, long-term rates do not price for growth. They price for inflation. Otherwise, we would have had in 1981, a Fed, we would have had a 10-year rate near zero instead of 15.5%. Right? But we had inflation that was double digits, so we had term rates that were double digits. Right? Didn't matter what growth was. Now, people price in the long rates with growth because growth tends to move up and down with inflation. Inflation creates growth, right? So, or growth creates inflation, rather. Sorry, backwards. All right, but inflation can be caused by other means, right? Disinflation can also be caused by other means rather than slow growth, greater efficiencies, competition from overseas, low inflation overseas. So we're in a situation, we believe, that we could see inflation trend below 2% for a long, long period of time, maybe for several or even many years. Right? The structure is different. If one thinks that the neutral Fed funds rate is around 2, Bill Gross said it today. We've been saying somewhere between 2 and 3 for a long time, and kind of get giggled at, by the way, by people. That's here and there, I guess. But if a 2% Fed funds rate is going to be neutral, then that means inflation is probably going to average less than 2% over the next few years. All right. So while tips might look cheap, and I know a lot of the wholesalers that go traipsing around and say, "Oh, look, tips are cheap. Buy our tips product." Do what? Because it's pricing in inflation below 2. Tips might be right. The tips might be right pricing in inflation below 2 at all maturities. It could definitely happen. There's another problem. There's a shortage of fixed income out there. There's not enough fixed income securities to meet the demand. The population's aging. You have individual buyers. You have pensions buying it, insurance companies buying it. Plus, in a global economy, you have currencies moving around back and forth, especially the U.S. dollar. Remember, most transactions happen in U.S. dollars in commodities. And when a foreign country sells their goods here, we pay them in dollars. Nobody here goes converting to yen or yuan or Thai baht or whatever it might be and pay them in their currency. We give them dollars and we say, do what you will. All right, if they convert it back to their home currencies, what happens? They sell dollars, which weakens the dollar theoretically anyway, and buy their currency, which theoretically strengthens it. Well, they don't want that. That's where they're cutting rates to zero in all these countries and going to QE. They want to keep their currencies weak. So what do? Roll it back into dollars. What do they buy? U.S. Treasuries. They can't buy stocks. They need the final maturity. They need the guarantee of the U.S. government. They need to know that the principal is secure. They can't go buy a group of stocks, and hope for the best. So they buy treasuries. All right. There's no shortage of demand for treasuries. In fact, there's a shortage of supply. And this is without the Fed buying. If the Fed sold its balance sheet, maybe it pushes the 10-year up to 2% temporarily, maybe even a little beyond. And then when that's absorbed, we're right back where we are. There's no alternative. Right? So everybody talks about the TINA situation in equities. There's no alternative U.S. equities. Buy equities, even though the fees are too high, especially when you consider that earnings are probably going to be less this year grow less this year than last year. Probably grow 5%, is the estimates we've seen on the S&P 500 companies. All right. So PEs between 17 and 18 seem a little high, but everybody says buy it. Why? Because no other place to go. The momentum will carry it. So we get it. In the equity market, TINA is a valid reason to buy it. But in the bond market, not TINA, that's not a good reason. It's got to correct. What we found is that most people outside the bond market who comment on the bond market know very little about the bond market. They know a little bit what they've maybe glossed over in a textbook or in a marketing guide or something that their firm put out to give them a basic education. They know nothing. Right? We hear it all the time on TV. We read it in publications. We hear from salespeople come traipsing through our office trying to tell us about floaters and tips and why they're going to move up. And doing this 25 years, I've traded just about every product there is out there. My subscribers know they can call me about just about any type of fixed income product, and I have an answer. I know how they. All right, I've been trained very well by some very smart people over the years in different product areas. And the Bond Squad staff is very knowledgeable. And we have all resources, trust me. Long-term rates are moving with inflation up or down. And there's a shortage of supply of bonds out there. And that's going to be true of municipals too. Municipalities issuing fewer bonds. Well, taxes aren't going down and the population is getting older. And they're probably not going to go buy, at least they should anyway, a small cap fund and say, now we're set for retirement. Not going to happen. There's a shortage of bonds. So, that is probably the story going forward. The bond market is not pricing in a U.S. recession. It's pricing in lower than usual inflation. Now, this doesn't mean the U.S. economy won't be affected by slowdowns overseas. It will, in all likelihood. All right, but it'll probably push through it, and there's probably be more efficiencies. And you saw that in the earnings reports. What disturbed us a little bit, but it wasn't totally unexpected given the holiday data that we saw a few weeks ago, the drop in wage growth in December. Only the average hourly earnings only went up 1.7. Fed likes to see job growth. I mean, wage growth around 3%. Good luck with that at this point. We're lucky we get 2. But we saw is not only more disappointing holiday totals, but word of layoffs. Companies are laying off, and it's going beyond the oil patch. The oil patch has affected almost every sector of the economy, from Walmart to McDonald's to Home Depot to all their suppliers. It's not just in the oil sector. Companies have to service them. It has a multiplier effect. So one oil job might create 5-6 jobs down, across the country. And those service sector jobs that say we're insulated, well, they're not so insulated. And we're starting to see that. And we're also seeing the companies that are reporting the best earnings are what? They're in tech and to some extent in healthcare. There's inelastic demand there. And if you want to look to where the savings at the pump is going, look at healthcare, look at repaying household debt, still deleveraging, right? And look at mobile and internet connectivity. Apple, big earnings. Netflix, good earnings. People will now buy the iPhone. They'll download more apps. They'll watch more movies, on TV. They'll get a Netflix subscription. They'll get Amazon Prime and maybe pay for the latest movies. It's $2.99 for an HD. Ask me how I know. So that's where the money's going. It's not. Nobody's getting a $20 a week on their fuel and going out making a big ticket item, big ticket item purchase. It's not happening. They get $20 a week. They spend the extra $20 a week, or they save it. They don't compel. They don't say, well, gee, I'm going to save $1,000 this year. Let me go make a $1,000 purchase. With what? They don't have the cash to do it. They have what they're saving. Okay, so that's the situation in the economy as we see it. It's not bad, but now with the durable goods number we saw the other day, we have to bring in question: did we grow at 3% in the fourth quarter? We downgraded, maybe went too much on this, to 2.7. Maybe it still is 3, but it wasn't just aircraft or transportation. The capital spending was up. Businesses aren't reinvesting or investing in their facilities here. And we think layoffs will continue, and companies will look to become more efficient and more cost conscious. Remember, energy not the biggest cost for businesses. It's labor, by far, more than half their cost by some estimates. Okay, so that's where they're going to look to cut. All right, wage growth. Why? There's this, because we're at 5.4% unemployment, that we must be close to full employment. Let's discuss NAIRU, which is the non-accelerating inflation rate of unemployment, or for simple, natural rate of unemployment, which is why we have our New York Knights uniform on from the movie The Natural. Let's talk about the natural level of unemployment. Natural, or NAIRU, is the level of unemployment which neither adds nor subtracts to wage inflation. All right, so inflation remains stable at that level. Now, it's a moving target. When we first came into the business 20 odd years ago, or at least the fixed income side of the business, we would be told, full employment, or the natural rate, is probably somewhere around 6%. By the time we got to the tech bubble, it was considered to be below 5%. After the tech bubble, it was surmised that it's probably back in the 5s. Okay, then during the housing bubble, well, maybe it's 5 or a bit lower. Got something that we'd like to show you about where unemployment might have to go to generate any type of real wage inflation. So let's look here. We have a chart, and let me make the circle a little bit bigger, and we'll show you. This is the unemployment rate chart. Okay, that figure right there that happened in December of 2005. we had the unemployment rate drop below 5%. Why is it significant? Right after that, we saw wage growth start to pick up. Right? So we had to get below 5% before we saw wage growth start to pick up at all. Why should it be any different now? And I'll tell you, it probably has to go lower. You know, Alan Zentner from Morgan Stanley said it could be in the high fours. Bond Squad has written, and we put it in print months ago, that to get wage inflation, we might need unemployment this time to be in the mid fours. Now, all of a sudden, when Ms. Zentner says it, it's news, right? Well, she has a bigger audience, I guess, than we were. We're only a small concern out of Stroudsburg, not the big wirehouse. Not knocking her. I mean, I think she's probably pretty close to being on. We're in the same ballpark, but it's probably going to take unemployment below 5 to get meaningful wage growth. There's a whole bunch of foreign workers ready to jump in. Technology is there, ready and waiting to take over if labor costs too much. And for all the talk that the baby boomers have driven down the workforce, the size of the labor force, it is estimated about a third of those who left the labor force are males, you know, between the ages of 28 and 35 or thereabouts. Okay, a third. If you get a little bit of wage growth, just a little bit, or they find that they don't have enough benefits or get tired of sitting on the sidelines, and they come pouring back in, that's going to put a cap on wage growth. The other part of this is you have a lot of women who used to be in the labor force who worked for healthcare who don't have to work for the healthcare anymore. Okay, they don't need to do that. It's quality. They're not getting paid enough to go through to put their kids in childcare and whatnot, so they're not in the labor force they were. All right. No coincidence is that the last time the labor force participation was this size was the late 70s, right before the big influx of women into the workforce. I mean, we had a big flow in late 70s for economic reasons. All right. If these people feel that it's in their best interest to come back in, that'll help hold wage growth down. So we could see, you know, wages grow at 2.5, 1.5. We could do 1.7 on an annualized basis in December based on hourly average earning. The Fed likes to look at the employment cost index, which is what our wage growth chart measures. And as you can see, we just ticked up to 2.1 in the third quarter. All right. And we grew at 5% in the third quarter. We probably didn't do that. We saw wage growth tail off near the end of the year. We could see when this prints on Friday, we could see the employment cost index dip below 2 again. You know, here is considered somewhere normal in this range. These are considered very high. You know, that's coming off the tech bubble. That's the housing bubble. But we should be at 3. We might be below 2. You're not going to generate a whole lot of inflation in the economy unless you can devalue the currency with wage growth at those levels. So what we're predicting is that inflation's not transitory, disinflation rather is not transitory. Oil prices will stay relatively low, could be in the 40s, 50s, maybe even the high 30s. Companies will become more efficient at everything they do. They don't need an army of nut and bolt people. They don't need them anymore. They don't need an army of clerks. They don't need an army of technicians. One person can manage multiple facilities from one location with a laptop. You don't need it. Competition for jobs is probably the greatest it's been, you know, in over 100 years, if not forever. There's very little wage growth. Doesn't mean that the stock market will do poorly. No, corporate profits could be resilient because they'll cut expenses if they have to, right? We don't see inflation. We don't see long-term rates rising. We do see the potential the Fed gives a total rate hike, but not enough to push floating rate coupons off their floors. But the economy might not be strong enough to keep some of these junk issuers solvent, especially in the oil patch. Remember, as we've stated in our reports, and it's important that people really should subscribe, that although Treasury yields have fallen, junk bond yields have risen because revenues and economic conditions are falling short of expectations. People ask, what's wrong with the markets? What's wrong with the markets? The only thing wrong with markets is that people priced in unrealistic expectations. Okay, so that's where we stand. You know, the Fed is probably not doing much, if anything, this year. Inflation's remain low in all likelihood this year, next year, year after. We probably don't see a neutral Fed fund rate of 2%, for 2018, 2019, maybe, unless there is an unknown that pops up. That's always the caveat. That's why you can't, take strategy and just go all in. You have to hedge it. But that's what we're seeing at this point. Workers will be hired when they're the cheapest option for output. That's it. When they're the most cost effective. Doesn't mean on a raw price, but when all things are considered, when transportation, logistics, whatever's considered, that's when they'll be hired. That's pretty much all we have for this evening. We're done a little bit early tonight. Please, if you have any questions or comments, contact us directly. Our number at the office is 570-424-1555. You can email us at thomas.byrne@WS&M, that's Whiskey Sam, the word and, the letter M.com, WSandM.com. And with that, have a good night. We would take some duration risk versus credit risk. We do not fear rising rates. We do fear a global slowdown a bit. Oil prices probably stay low. And it is what it is. Have a great night and give us a call. Thank you.